Hey everyone, this is Robert Keens with goldsilverpros.com, and I have an update for you on the silver market. I've been talking the last couple of weeks about the silver futures market and everything that's going on. Produced a couple of videos predicting the increase in silver price that we saw this week from $19 to about $23, and also showed you what I called the silver war that was going on between the longs and the shorts and COMEX. Well, we have an important update from the exchange on how they're treating contracts and how much margin that the traders have to hold. Margin is essentially money that's put up against their contract position to make sure that they're going to be able to support that contract position. I'm going to show you something that talks about the change that was made on the futures market. It's done in the form of performance bonds, which is actually a margin. And I'm going to read this sentence here, which basically explains what they are. Performance bonds, also known as margins, are deposits held at the CME clearing to ensure that clearing members can meet their obligations to their customers and to CME clearing. Performance bond requirements vary by product and market volatility. And we're going to go down here a little bit further, and it's going to explain basically how the margin is used, the performance bonds used in the margin. Suppose a trader established a position to buy or to go long a September E-mini S&P 500 futures contract on June 13th. When the contract was trading at 1,050 points. CME at the time required an initial performance bond of 4,000 to trade that contract with a maintenance bond of 3,200. If the price variations of the contract bring the account balance to under 3,200, the trader will have to deposit additional funds to bring the account back up to 4,000. So what that essentially means here is they went long. So they put up $4,000 of a bond against their position. The S&P 500 mini fell enough that it brought their account below 3,200. So they had to deposit more money in to make up for the difference. In other words, when you're playing the futures market, if you take a short and the price rises too much, you have to put in more money to ensure your short position. If you go long and the price falls too much, you have to put in more money to ensure your long position. So what I want to do now is show you the change that was made, the announcement that was made on the CME. So this is a spreadsheet I downloaded from the CME group, and here you can see we're going to look at the silver futures, and I'm focusing on the silver futures because we know that there's a lot of volatility in the silver futures market and that the longs are starting to win. I've done videos on that. So we're going to look for the CXSI designator, which is silver on the chart, to see how the margin may have changed. Before we focus specifically on silver, I wanted to show you guys essentially that there was more than one change here. So if we look at the table of contents, we had changes to soybean meal futures, changes to corn futures, changes to silver futures, wheat futures, Brent crude futures, some additional soybean and wheat, so on and so forth. Chicago, a specific type of Chicago wheat future. So there were changes made to a lot of products, but silver is the only one in which they actually increased the margin requirements to hold a contract. So a lot of these were unchanged. As you can see, there's zeros here in this column right here, margin change. And as we scroll down, we see that the rest of these are negative, negative 50, negative 500. So most of the products, they're actually reducing the margin requirement because it's indicative of less volatility in the price. So there's not really a price war going on as you would, as there was in silver that we documented in these other products on the exchanges. So all negative, all negative, all negative, all negative, all negative, negative 80, negative 50, negative 300. So we're going to scroll down until we get to the highlighted section. I've highlighted silver here for you. And again, that's a CXSI designator. This is for silver. And on the contract silver, the old margin was 8,000, but as of the 24th, any new contract that's entered into now has to have 9,000 a margin. That's an increase of 1,000. This is the only positive number on this news release from the CME. No other future had a positive. They either dropped or kept the same every other future on this chart. Basically, what they're saying is because of what they expect to be the increased volatility in the silver futures market, they're requiring more margin to back those positions. The CME is basically saying they think the price of silver is going to fluctuate up and down more than it has been. So we're going to go back to the silver price chart that I showed you guys earlier this week, and we're going to try to figure out why that's the case. Again, I've charted the silver continuous contract from the CME, and you can see, I'm actually going to back this out just a little bit. Let's go out about 12 years like I had it before, and we'll update. And remember when I said, even when the price of silver had gone to 50 bucks, we had like this mean line of activity in the futures market. All of these red and green lines represent the longs and the shorts, basically battling against each other. This is volume. And notice how it spiked up here. Well, when you have that much more long and short positions being taken in the market, that means the price volatility is going to increase. And as I showed you last week on this 50-day moving average represented by this blue line here, punched through the 200-day moving average, we saw this very sharp increase in the price of silver. And graphing the accumulation distribution at that same time that the 50 popped above the 200-day moving average, boom, we can see the accumulation of the long futures. In other words, the longs are winning in the market. That increases the price of silver, but also you see this much higher volatility going on right now as people battle that silver price up and down, even more so than when silver was at its most popular in 2011 after the last financial crisis. So that's why the CME is increasing the performance bond, because those are the margins. And again, it's market volatility. This market volatility is why they're increasing that performance bond. The CME is expecting bigger up and down movements in the price in silver. I'm expecting that as well. I think silver could retrace at one point, but I think it's going to go much higher in the future. And I think that because there are so many shorts on the COMEX towards silver, the CME is increasing the requirements for margin. Because if the silver price is going to continue to go long at the rate it's going at, that increases the volatility of the silver price over time. They're going to need more margin to satisfy those short positions that those bullion banks own. And this is a positive sign towards the silver price continuing to increase. And further, that there is going to be much more volatility going on in the silver price, a bigger war, if you will. So we'll go back to the chart, that this volatility is expected to actually increase over time. I really think this is positive for the silver futures price. The fact that silver is the only really the only of the on today's release is the only one that had increased margin requirements here of an extra 1,000. The CME knows what's going on. They have all of the market data. They see the trades. They know there's volatility. I think they think that silver's price is going to continue to rise, and this is basically going to the silver short saying, hey, we need more margin on your account. You guys are going to continue to lose money as these longs come in and either stand for delivery or just continue to take additional long positions in the futures market. So really, really, really big news today in silver from the CME group. More data to show that we think the silver price is going to continue to rise. I also expect the shorts to come in and try to bring it down, to punch it down, to short it, to keep that silver price within a range. I think they're going to lose. And I think this table right here explains what the CME sees in the data that we expect going forward. So all you silver bulls out there, this is actually really good news for you. Expect more volatility in the price, but expect silver to continue to reach higher and higher plateaus. And the participants are going to continue to have to put in more money to ensure those short positions they have, which is good. It means they're going to have to front more money for those short positions. It means they could lose more money as the longs continue to win that market, which is finally, after 9 years, really, really good news for silver investors. So I wanted to share that with you guys. Just a quick note here, but like I said last week, as I saw this data start to take place on the futures market, and I saw this big move in silver coming, and I called it 4 or 5 days before it happened. I'm going to continue to watch what goes on in the futures markets and keep you guys updated in case we think that there's going to be larger moves in the silver price moving forward. Once again, this is Robert Keens of GoldSilverPros.com.